macroeconomics part 2. So this is focused on money, monetary policy, taxes, and fiscal policy. So macroeconomics, we're talking about the economy as a whole. As we discussed in microeconomics, the government must sometimes intervene to help stabilize the economy. So what are some different ways the government can impact demand for the entire economy? Does Buyback want to try? Yes, we can. So good question. We can do that. That's a good idea. The That's a good idea. We could do that. Have we do that next week? So let's do that next week. So the next week we will go through go through the case study questions. Yeah, no problem. And and we'll go through case study questions and answers next week. So that's a good idea. So let's try that next week. The case study questions and answers we'll go through next week. So we'll do a group discussion. We'll do a discussion where I'll ask upon everyone to contribute, and then we'll brainstorm the correct answers to the case study, and everyone will contribute. That will be a good learning, a good learning experience because everyone will be contributing and we'll brainstorm how to answer all of those questions. So that's great. Great idea. So the break week will be the break week, it will be it's not next week, it's the week after. So it'll be February 27th to March 3rd. Yeah, so break week is February 27th to March 3rd. So we'll have class next week, but we won't have it the week after. Yeah. So good question. So different ways the government can demand the economy can impact demand in the economy are government spending. Government spending is one. Taxation. So like government spending increasing, tax decreases, money supply increasing, and interest rate decreasing. So they can do a lot of that kind of information here. And for government spending increasing, what types of programs can they create to increase government spending? Does Berkey want to try?
Uh, can I have the question again, Professor?
Yes. So what programs can the government create to increase spending and impact and increase demand?
Um, well, they can lower interest rates and buy government securities and reduce the service of requirements to increase money supply.
Yes.
Um,
Yeah, that's great, Broku. Excellent. Yeah, those are great. Yeah, that's exactly what they do. Yeah. And excellent job. And then they can increase employment insurance benefits. So people that are out of work get more money from employment insurance. And also they can increase welfare payments. So like people in need of government assistance will get more support from the government. Also, they can increase payments to Ontario Works, ODSP, and other programs to to support people in need of income. So those are things they can do. The government can increase healthcare and education spending to support the the hospitals, doctors, nurses, and make jobs. So those are things they can do. Infrastructure development, social welfare programs, that's great. Hassan. Public-private partnerships, excellent. That's great, Hamza. Sorry. Yeah, great job, Hamza. Yeah, those are great ideas. Yeah, the infrastructure development is a big way to grow our economy. Social welfare programs, public-private partnerships. A great job, Hamza. Yeah, public-private partnerships are a really good thing that they do. They they match funding from private companies to create a new initiative. So they do that now with private colleges, like with there was so Niagara College, they partnered with Toronto School of Management to make a public slash private education uh, education school. So this is an effective way to make schools today. Yeah, public-private partnerships are a good idea. And then what does anyone else have any ideas of what the government can do to impact demand? So negotiate trade agreements with other countries to increase exports, which can increase demand for goods and services. That's great, Lee. Great job. Excellent work, Lee. It was great. So yeah, that's the great example. Thank you, Lee. So yeah, a great job, all of you, on the brainstorming for this. So I'll take a snapshot of this and send it. So here it is. So money, let's talk about money now. What is money? So history of money. So money, before money, there was bartering. So that's trading goods for goods. So the problem is with that, it's very difficult to trade. Like let's say you want to trade, let's say you want to trade. This is very difficult. Like let's say you want to trade bread for a car. Very difficult, right? It's very hard to trade certain goods for other goods, like bread for a car. Can anyone think about other examples of what would trading a product for another product, or a product for a service, or service for a product? Like it gets really tricky.
In history, well, they were trading seashells with different kinds of goods, like obsidian rocks and the things that people can need, uh, what they don't have on the part that they live with the other people around. So it should be something that uh, both parts like benefit from.
Yes, yes, good job, Berker. Yeah, the exactly. If this works, you need to, like you said, both parties have to benefit. So double coincidence of wants is very important. Like you said, like both people need to want the product for that to work. That's great. And then rice for a house, that would be very difficult. Food grains for other articles in the shop and barter system. Yeah. So it gets very tricky. And then commodity money. So commodity money, that's what happened before we have our money today. What happened was in so before 1971, the US dollar was convertible to gold. And then in 1971, the US dollar couldn't be converted to gold anymore. So there wasn't any sort of intrinsic value to money anymore because money was just money, it was just paper. And the so before 1971, money was guaranteed by gold. So like you could trade US dollars for gold by talking to the US government. And then by 1971, money was not guaranteed by gold. However, it was still guaranteed by the US Treasury. So that really changed things. And then the money money's trusted because money is trusted because it is backed by governments of the world. So that's why people trust money, because it's backed by governments of the world. That's a very big thing because the government guarantees the money because they can tax citizens uh to guarantee the money. So that really provides trust to people, and that's why people trust money, because it's guaranteed by the government. That's the reason why people trust money for the most part. uh and that's why we use it so often, because it's trust, like people trust it and it's guaranteeable. Yeah. So I'll put this into the chat here. So functions of money. Money is a medium of exchange. So we exchange money for goods and services is widely accepted. It's a measure of value. So we can compare the value of various goods using money, and it's a store of value. So money can be saved and used at a later time. And then characteristics of money. So for money to be accepted, it should be portable, durable, divisible, recognizable, accepted, and protected from counterfeit. So the Canadian dollar, the US dollar, they all have every one of these criteria. So what we'll do in the next activity here is we'll do this as a class here. So decide if each of the following items fulfill the functions and characteristics of money. Put a check mark if they do and put an X if they don't. So cows. Which of these do cows fulfill? Does Chica want to try? Yeah, recognizable would be good. Yep, that's great. So recognizable. And then what else? What else would they fit? Does Daenerys want to try? Yeah, they could be a medium exchange, yes. And what else? Does Femina want to try? Yeah, it could be a store of value. Yeah, some people do use it as a store of value. Yep, that's great, Elmo. And then uh with what else could it uh could it be a measure of value? Could it be portable? Could it be durable? Could it be divisible? It could be widely accepted. So I wouldn't say it's divisible because you can't really divide a cow, right? Because it's yeah, that would be yeah, it's not good. Um then widely accepted because cows are traded internationally, especially the countries that deprive livestock measure value. Yeah, widely accepted, yes, and then measure value. That's great. So widely accepted. Yeah, because there's a lot of, like you said, there's a lot of countries that don't have it. And then is it portable and durable? Are cows portable and durable? Yeah, exactly. No. Yeah. Yeah, good job. And then what about silver coins? Would they be a medium of like which ones would they fit? Medium of exchange, measure value, store value, portable. Medium of exchange, measure value, all. Yeah, so medium of exchange, yes. Measure value, yes. Store value, yes. Portable, yes. Durable, yes. Divisible, yes. Recognizable, yes. Good job, Lee. Yeah. The good job, everyone. Lee, uh, Ephamina, Elmo, Hamza. Great work. And then flowers. Would they fit any of the criteria here? Yeah, yeah, I think yeah, I believe you're right. I believe none of the criteria would be met by flowers. Just yeah, it really doesn't meet any criteria here. So good job, Efamina. That there's no criteria here that it would meet. And then what about plastic water bottle? Would it meet any of the criteria? Yes, portable it would meet for sure. Any other criteria? Durable? Yes, excellent. Excellent job. Yeah, that is correct. Yes. And recognizable, yes. Anything else? Measure of value. Yeah, it could be, yeah, for sure. Because some water bottles are really expensive. Like I've seen that are some of like $50, like $50. It's like some of them are way expensive. And some, yeah, some of them are very expensive and people value them very highly. So they can people think when they have a nice water bottle, they really have a high value for it. So that is a potential measure of value. Yeah, exactly. Emma. Yeah, like glass bottles. Yeah, there's a lot of them out there that you see them at stores. Like I'd never buy it, but they're nice water bottles, right? There's some really nice ones out there, and glass bottles. Some of them are even art pieces, right? Once they get into an art piece, it can become an investment. If because some of them are similar to art, and that could even yes, widely accepted for sure. And that could even border into store value if so like if it's art. So like it could be art potentially. And I think some of them border on art for sure. And widely accepted like Evian or Aquafina or Dasani. Aquafina, that's great. Yeah, great point. And then are they divisible slash or a medium of exchange? Yeah, I agree with you. No. Good job. And what about diamonds? Are diamonds any of these criteria here? Yeah, I'd agree with you. Divisible would be a hard one because yeah, it's very hard to divide, but it's debatable. Immediate exchange for sure. Measure value, yes. Store value, yes. Portable, yes. Durable, yes, I think. Recognizable, yes. Widely accepted. Yes, I think. Yeah. Yeah, like divisible, it's divisible. It could probably go either way. I bet we could debate on divisible. Yes, yeah, exactly. Like you can't really damage a diamond. So that's a good point. You can't really damage a diamond. You could you can divide it, but you can't really damage it. So that's so yeah, good point. You can't really damage it. You can divide it into smaller sections, but it's not really damaged. So yeah, good job everyone. So I'll cut residuals then embed in smaller ornaments. Yep, that's a good point there. So yes would be yeah. So this shows This shows the this shows all the characteristics of currency, what money is, what money isn't. So it's a good exercise to determine like what money should be. So I copied and pasted that into the chat so everyone has it. It's in the chat now. Great job, everyone. And the history of banks. So coins to paper money. People began to take their coins and put them into banks. Then banks gave people receipts, and then paper money was born. Yeah, so that's how paper money was created. And banks had a lot of gold in their vaults, and people didn't actually pick up all their gold at one time. So a bank just lended. So what they did was they loaned money that they had in the bank to make profit off the interest. So this requires people to not take out all of the money they deposit. So banks, what they do is they lend out all of your deposits. Banks want people to deposit their money and save it. Why? When people deposit their money, the bank can take that money and loan it out to other people. So the borrowers pay interest to the bank, and the bank earns interest when people borrow money. The problem with banks is that when people panic and want to take out all their money, this is called a bank run. And they're worried that the bank's going to go bankrupt. But the problem with that is the bank has lent out that money. So the bank has lent out all of the money that is deposited. So people that want to take out all of their deposits cannot. So that's the problem with the bank run. So like a bank run is problematic because people's money is not in the bank right now. It is lent out right now. Yeah. So that's the problem with bank runs, because the money's not actually in the bank right now. So that's a big problem with the bank run. So central bank is born. Central bank is a national bank that provides banking services to the government and for commercial banks. So commercial banks provide services to citizens such as saving, borrowing, mortgage, etc. Central bank loans bank money in case of bank runs. They don't provide services to citizens. They issue currency and they manage foreign reserves. Central bank controls monetary policy on behalf of the government. So commercial banks, they create money through credit creation. So this is called fractional reserve banking. And through loaning out money to other people, they create money. So what happens is let's say John deposits $1,000 into the bank. The 10% of it has to be held in reserves. So $10 is sent. So $100 is left at the bank, and the other 900 is loaned out to other people. So the bank loans $900 to a local business owner, and then that local business owner deposits that money into the bank, and then the bank keeps $90 that $900 and loans out that other 810 to a driver. And then so this is how, and then the 810 was earned by another person by selling tires, deposits in the bank. Bank keeps $81 deposit and loans up the other $729. So this keeps going until there's no money to be loaned out by the bank. So the bank just keeps loaning out money over and over and over. That's how. So the bank, every deposit that goes in the bank. So in this case, every deposit that goes into the bank is lent out. Yeah, is lent out. Like 90% of every deposit. In this case, 90% of every deposit that goes into the bank is lent out, and 10% is kept in the bank. As this continues over and over and over and over through every economic transaction, money is created more and more. That's what happens in this example. It just repeats itself. Like there's like another transaction, another transaction, another transaction, another transaction, and the money is created over and over and over. So that's how money is created. So in this case, we can calculate total deposits and total credit creation using the credit multiplier. So shoot. So the quizzes for this course, we won't go into the mathematics, like we won't do the mathematics like this. Don't worry. We won't have calculations like this in the course. This is more for just showing how it works. So the credit multiplier is what is created from deposits, like the amount of money created from deposits. So like this kind of, these multipliers show what's created by deposits. So the limitations of the money multiplier equation are that the money multiplier equation assumes that all excess reserves get translated into new loans. However, amount of people such businesses looking for loans might be small as people save. The type of people looking for loans might not be the people the bank wants to loan to. So we'll go into monetary policy. Yeah, don't worry too much about don't worry about the calculations up there because they won't show up in the midterm or the quizzes. That's just more of an overview of, if you keep going with economics, you'll see calculations like that. It won't, that's above where the course is. The course is more focused on the non-math side, so don't worry about the calculations. So monetary policy is when the central bank impacts the money supply and interest rates. So monetary policy, the whole key is to impact aggregate demand. So they change interest rates in the money supply to change aggregate demand. So that's what they do. And that's the whole focus of monetary policy. So monetary policy, interest, so monetary policy, increase in interest rates and reduce money supply, decreases aggregate demand. GDP. And then decrease interest rates and increase money supply, increase aggregate demand. So that's what happens when you, that's what the government does to change monetary policy. So I'll put this in the chat here. So interest rates and money supply are linked strongly. So if the interest rate increases, the money supply decreases. Yeah. So if the interest rate is low, people want to borrow money. So demand for money increases. So in this case, if the interest rate decreases, more people want to borrow money because it is cheaper to pay off loans due to the lower interest rate. Money supply increases. And then if the interest rate increases, less people want to borrow money because it is more expensive to pay off loans due to the higher interest rate. So money supply decreases. So that's what happens here. That's how it works for the most part. So I'm gonna send that in the chat to everybody. So the interest rate is the cost of borrowing or the reward for saving. So the interest rate determines how much people will borrow and save. The interest rate is high, it is expensive to borrow because you have to pay back more money. The interest rate is high, it's a great time to save because you're saving more money. If the interest rate is low, it's cheap to borrow because you don't have to pay back so much money. If the interest rate is low, it's a bad time to save because you're not earning much interest. So how can the central bank use this information to increase or decrease aggregate demand? So I'll put this in the chat. So how can the central bank use this information to increase or decrease aggregate demand? GPU. So does Alma want to try this one? So they can use this information if they want to increase economic growth. If they want to increase economic growth, they will decrease interest rates and increase the money supply. Also, they can, if they want to reduce inflation, they can increase the money supply and increase interest rates. So that's what they can do here. Those are the things that they can do to correct the economy. So, yeah.
Professor, so it is highly connected with the economic cycle, like on recession or on the peak, they can actually control the inflations and everything.
Yes, exactly. So this would be at peak. Exactly. So yeah, at peak, inflation is usually too high. So they have to, so they can, so I should say, I made a mistake here. I meant, so here decrease. So decrease right here. So yeah, so like you said, at peak, so at peak, inflation is usually too high. So they need to they need to decrease the money supply and increase interest rates. Yeah. So yeah, good point there. That's usually what they do at that part of the business cycle. To because we don't want inflation too high because we can't afford anything when inflation's too high. That's why. And then here, I put that in the chat for everyone. So here, the expansionary monetary policy that's done during recessions, they do that through decreasing interest rates, and that encourages people to borrow and spend, therefore increasing aggregate demand and increasing the money supply, so making more money available to people, thereby increasing aggregate demand. So this leads to more GDP. So that's what they do to expand the monetary policy. They decrease interest rates or increase the money supply. That's what they do to expand monetary policy. And they usually use that at the trough. So they do that at the trough of the business cycle to boost the economy into recovery / expansion. So here they increase, so they would increase the money supply and reduce interest rates. And also reduce the reserve requirement. Yeah. So that's all they can do. That's what they can do to solve this situation here, to get the economy back into growth. So that's what they do for the most part to get the economy back into growth. So I'll send everyone this. So do you remember the prosperity cycle? So higher aggregate demand leads to increased production, leads to greater levels of employment, leads to increased income, leads to increased consumption, and then it keeps going like this. So like each one leads into another. So each one leads into each other. So if there's an increased consumption, there's higher aggregate demand. There's higher aggregate demand. There's more increased production. There's more increased production. There's greater levels of employment, and so on and so on and so on and so on. So how easy monetary policy works: buying government bonds and other securities. Government bonds are a way that governments borrow money from banks and investors. They sell bonds, investment opportunities to investors and banks, and receive money in return. Investors and banks loan governments money because they expect to receive the principal back with interest. So when the government buys a bond back, they're turning the bond back into cash, i.e., putting the cash back in the hands of citizens. This increases the money supply and therefore increases aggregate demand. Cash ends up back in the banking system, multiplies to money multiplier in the fractional reserve banking system. So how they increase, this is how they increase the money supply. The Bank of Canada increases the money supply through buying government bonds from banks across Canada. So that's how they increase the money supply. They buy government bonds from banks across Canada. And then they go a step further when they want to increase the money supply further. The Bank of Canada buys bonds from companies and stock of companies. So that's what they call quantitative easing. So like this increases the money supply further. They do this when they want to increase the money supply a lot more. So that's what they do. Yeah, so that's what they did in the US during the recession of 2008, 2014. And they did this during COVID. And that's a big thing that they did just to increase the money supply. So how easy money works: lower interest rates is a clear way for the bank to communicate to the public what policy they're pursuing. This makes it easier for banks to borrow from the Federal Reserve and thus make more loans available. So reserve requirement. the central bank can decrease the reserve requirement. This means banks can loan out even more deposits, and this increases the money supply further. So this will increase the quantity of money that's in the economy and increase GDP also. So decreasing the reserve requirement is good for increasing the money supply. So yeah, decreasing the reserve requirement is something they can do. They can lower interest rates, and those will increase the money supply. Both of those things here can increase the money supply. And then tight/contractionary monetary policy. So this is done during high inflation. Canada's doing this right now because inflation is too high in Canada. So they're applying this right now to our economy. And they're increasing interest rates. They did this all last year to bring down inflation, and they're decreasing the money supply just to bring down inflation. So this is exactly what the government of Canada is doing right now. The Bank of Canada and the government of Canada is Bank of Canada. The Bank of Canada is increasing the increased interest rate, and decrease the money supply in 2022 to bring down inflation. Inflation was too high in 2022. Yeah, so that's what they were doing to bring down inflation. So it's usually used in a peak to help slow down the economy and decrease inflation. So that's where we're at right now. We're at basically the peak. So they're trying to bring down inflation. So do you remember the recessionary cycle from last week? Tight monetary policy can stimulate the recessionary cycle. So tight monetary policy leads to lower aggregate demand, leads to decreased production, leads to lower levels of employment, leads to decreased income, leads to decreased consumption, and then it goes on and on and on and on. Everything leads to each other here. And how tight monetary policy works. So open market operations. They sell government bonds to decrease the money supply. So they take money out of the money supply and replace it with an asset. So they just sell government bonds. So in order to decrease money supply, so Bank of Canada sells government bonds to decrease the money supply. So that's how they decrease the money supply. They just sell government bonds. And they raise interest rates. So this is done to make it harder for banks to borrow from the Federal Reserve and make it more difficult to make more loans. So it's hard. So if you're paying a higher interest rate on your loan, if you are paying higher interest rates on loans, you will borrow less. Therefore, less money is created. And then also the central bank can increase the reserve requirement, so they can't loan out as much money, and this shrinks the money multiplier. So yeah, also to reduce the money supply, to reduce the money supply, banks can increase the reserve requirement. They can do that too to reduce the money supply. And can the central bank change the foreign exchange rates to impact aggregate demand? Yes. So in this case, they can change the foreign currency exchange rate. So if the central bank wants to increase exports, they can do this through decreasing the value of their own currency. So this is what they do. This increases GDP. Yeah, increases aggregate demand. So a lot of countries use this to increase aggregate demand and GDP. So so making your currency go down in value, they do this to increase aggregate demand. So they can do this through lower interest rates, higher money supply, leading to lower value of the currency, higher exports, higher aggregate demand, such GDP. So that's what a lot of countries do to grow their economies. It's a good strategy because it does work. So that's exactly what happens here. If they have a lower value of the currency, they're gonna have higher exports. It's like lower value of currency, higher exports, because it is cheaper to buy for other countries to buy your goods. And then foreign currency exchange rates, so contractionary monetary policy. If the central bank wants to decrease aggregate demand, they can change the foreign currency exchange rate. So for contractionary monetary policy, the central bank wants to decrease exports. So they do this by increasing the value of their currency against another currency. So they can do this to, if they want more imports, if they want more imports, if they want to buy more goods from another country, they can increase the value of their currency through increasing interest rates and reducing the money supply. Yeah, so they can do this, and they can also do this through increasing reserve requirements. So they can do that. So let's say they want to buy more goods from another country, they would increase the value of the currency through these methods here. So taxes. Taxes money paid but to the government through the purchase of goods and services and through income. So we're paying taxes every time we purchase goods and services. The government spends tax money on social services, welfare, infrastructure, healthcare, education, etc. So taxation, there's income tax. That's tax on income, wages, salaries, etc. Corporate income tax, percentage of a company's annual profits. Sales tax payable on the purchase of consumption on goods and services. Excise tax, taxes on products that we don't like socially, like cigarettes. Capital gains tax, tax on the gains from stocks or other assets. Property tax is tax on value of buildings and land. So how do we design a tax system? So we do benefits received, usually associated with consumption taxes, versus ability to pay income taxes. So efficiency, we compare raising the amount of money but not causing disincentives versus equity fairness. So there's different categories of taxation. Progressive taxation is when households with higher incomes, they have to pay a larger share of their income tax than households with lower incomes. Proportional tax, where all households pay the same share of their income tax. Regressive tax, where households with higher incomes pay a smaller share of their incomes and tax than households with lower incomes. Progressive tax system is when the first amount of income is taxed, the lower amount the rest. So your first $0 to $10,000 is taxed at 15%. Your next $10,001 to $50,000 is taxed at 20%. Your next $50,001 to $100,000 is taxed at 40%. These are called tax brackets. So for example, a company with taxable income of $27,400 will be taxed as follows. So $10,000 times 15% equals $1,500. $17,400 times 20% equals $3,480. Total taxes paid, $1,500 plus $3,480 equals $4,980. So it doesn't sound like any country would ever want regressive taxation, because rich people likely shouldn't get lower tax percentages than the poor. So that's yeah. So tax rates do not equal tax paid. Although Hamza asked, due to the USD crunch, few countries depreciated their currency value to reduce imports and encourage exports. Do you think it's viable, Prof? Is it possible to appreciate later? Yes, I think so. There's a lot of benefits of increasing exports. So depreciating a currency to increase exports is beneficial because your country will have higher economic output slash GDP slash aggregate demand. So that's beneficial. Your country will have more jobs. That's beneficial. However, you will not be able to buy products from other countries as much due to the low value of your currency. So so what types of products do you like to buy from other countries? Yeah, cars, yeah. Like Mercedes, let's say, BMW, Toyota, let's say, right, etc. They are all mostly from foreign countries. So if our dollar depreciates, we cannot buy these as much because they become more expensive. So even though our economy is growing more due to more exports, we cannot buy as much from other countries. So it can appreciate later. So what happens is your increase in exports due to currency depreciation will increase your GDP and economic growth. This will then increase the value of your currency because of the higher output. Yeah, so higher economic growth will increase your currency value. So your currency will eventually appreciate due to the higher exports. Yeah, no problem, Hamza. So that it's kind of like a cycle. Like you have you can depreciate your currency a lot, and then eventually you have so much exports from that your currency will go up again, and then you'll be able to have higher imports. So we can probably graph that here. So good question, Hamza. So we could probably graph that. So maybe so maybe we can graph this here. So just trying to think of how we graph this. This, let's say exports, let's say exports would be here, imports would be here. Wait, let's say currency appreciation. And let's say like exports on here, imports. So as the currency depreciates, exports will increase like this, like kind of like that. And then what will happen is due to the higher exports, it will kind of go like this way eventually. So it'll kind of wrap around. Once it's going like this, it'll eventually like wrap around and go this way, basically. Yeah. Yeah. So it's so yeah, it is it goes the opposite way eventually. Yeah. Yeah, good question, Hamza. That was great. So here's the types of budgets. The government brings in money through taxation. So citizens pay various types of taxes. So the government never usually has a balanced budget. It's the US will never have a balanced budget. Likely. Like they used to. Uh like in the late 90s they balanced budgets, but they may never have one again because the US's case, the US will unlikely have a balanced budget anytime soon because they import so much from other countries. So like they have a very strong currency. Their currency is extraordinarily valuable. And they import constantly because their manufacturing is not it is in other countries, is done by other countries. The US economy is mostly a service slash high tech manufacturing economy. So their non high tech manufacturing is done by other countries. So yeah, for them, government spending in the US is higher than taxes always. Yeah. So that's why. So that's what you call a deficit. The government spending is greater than taxes, and that's likely going to be always the case in the US. And then balance is when government spending equals taxes, and then surplus is when government spending is less than taxes. So the balance of deficit budget, you either raise taxes or cut spending. So debt and deficit do not mean the same thing. Deficit is when spending is greater than taxes in a year. So for a year's time, for a year, and then debt is money owed to someone. So it's all of the added up deficits over time. Yeah. So that's the difference between debt and deficit. Deficit's like the debt for a year, and deficit is deficit's all. So deficit is basically the debt for a year, and debt is all of the deficits added up. And then deficit. So cyclical deficit is when the government needs to increase their spending on social services because there has been a decrease in consumption. So spending is greater than the amount brought in through taxes. And then structural deficit is a deficit during periods of economic prosperity. So automatic stabilizers are mechanisms built into the economy that are continuously stabilizing the economy. So they include unemployment insurance, progressive taxation, and other welfare programs. So they adjust the economy when there's recession. So automatic stabilizers So they jump in. Automatic stabilizers adjust immediately during a recession to provide support to people in need. So like people out of work will get income through employment insurance. People will pay less tax when they lose their jobs due to progressive taxation. Income assistance will be provided to people that don't make enough income in recessions. So that's what happens during a recession. All these things jump in to support people. So that's the benefit of government programs. They call them safety nets. These automatic stabilizers. So they're called automatic stabilizers, are also called safety nets. Yeah, because they keep people okay. So fiscal policy. Fiscal policy is when the government impacts government spending and taxes. So fiscal policy is the government's way of influencing the business cycle through changing government spending and taxation. So the government's expansionary fiscal policy is when government spending increases and taxes decrease. Contractionary fiscal policy is when government spending decreases and taxes increase. Expansionary fiscal policy is used in recessions to encourage consumer spending. Lower taxes increase disposable income. Increase government spending to help people suffering from difficult times. So expansionary fiscal policy is used at a trough to help boost the economy's recovery / expansion. So they do this through increasing government spending and reducing taxes to grow the economy. So that's what they do to grow the economy. And then contractionary fiscal policy. That's done during times of inflation to discourage consumer spending. So it raises taxes to decrease disposable income, and it's decreasing government spending. So contractionary fiscal policy is when they slow down the economy and decrease inflation. So they do this through reducing government spending and increasing taxes. So we'll try practice with fiscal policy. So I'm going to bring that up for everyone. So fiscal policy refers to a government's policies on what and what. Does Hillary want to try? Also, okay, so that would be government spending, which is leakage, and then taxation is an injection. And then during periods of economic expansion, a progressive what means that incomes increase, a greater proportion of aggregate income will be collected as tax. Does Joanne want to try? To be tax. Then all governments prepare an annual what, which lays out their plans for taxes and spending policies for the upcoming year. Yes, Job Hamza, budget. And then these are usually updated and revised. Good job, Perna. When are they revised? Like, are they revised regularly? Yeah, annually. Good job. Good job. Then Keynes has made popular the notion that the budget is a major tool for managing the economy. The government will produce one of the following three budgets. So, a budget surplus. In this situation, taxation is what? Government spending. So in this case, it'd be more. So, because they have more coming in than going out. So, when should they have a budget surplus? Yeah, income is higher than expenditure. Exactly. Yeah. And when should they have it? Should they have it in peaks or troughs or expansions or recessions? Yeah, peaks. Good job. Yeah, peaks. Yeah. And then budgets, a balanced budget. Good job. Balanced budget. What is taxation and spending in a balanced budget? Yeah, same. That's great. And then government fiscal policy does not affect what? Demand. Yep. Good job. And then what's a budget where government spending will exceed taxation? Yes. And then when should it happen? During a peak, trough, recession, or expansion or contraction? Yes, trough would be it. Yeah. And then what else? What else would it work in? Yeah, contraction. Good job. And contraction. And then Keynes argued that deficit budgets are necessary during economic contractions and would be offset by surpluses enjoyed when the economy was what? Mm. Yes. So inflationary gap, yeah. Inflationary gap slash expansion slash peak. The deficit caused by the increase in government spending needed to offset reductions in consumption and investment is called what? Yeah, good job. Excellent. And then any amount spent by the government in excess of that required to offset reductions in consumption investment is called a what? Yep. Great job, everyone. So recap, fiscal versus monetary policy. So fiscal policy is controlled by the government. Tools used are government spending and taxes. Monetary policy is controlled by the central bank. Primary tool used are money supply and interest rates. Fiscal monetary policy limitations. So demand side only cannot impact supply. So they can't impact supply at all. It's only impact demand. Expansionary policies cause inflation. Contractionary policies cause unemployment. Fiscal policy, there's issues with government corruption. Governments can steal money in cases like that, or give it to people that are connected to government officials, which does happen. Slower process. Then monetary policy effectiveness in recent years is uncertain. It's very hard to figure out if it's working because, yeah, like during 2008 to 2014, there was really no noticeable increase in growth. And also, monetary, it's not targeted. You can't really target a monetary policy. And then, so expansionary monetary policy, increase the money supply, decrease interest rates. Fiscal policy, decrease taxes, increase government spending. Contractionary, used during times of high inflation to slow down the economy. Monetary policy, decrease money supply, increase interest rates. Fiscal policy, increase taxes, decrease government spending. So I'll take a snapshot of this. This is I posted this PowerPoint in week set your week this week. So it's on there, and this is slide 60 if you want to look back on that, but I took a snapshot for you here. So let's practice. 4 actions that can be used at a peak to help slow down the economy and inflation are what? What can you do to slow down the economy and inflation at peak? Does Lee want to try?
Hey, Professor, increase interest rates,
Yes.
decrease the money supply as well.
Excellent. Great job, Lee.
Yep.
And then I could try Zodi. What else can you do? Are there any other options you have?
Increase taxes.
Yes, this is a good one. Yeah. Increase taxes.
And
Yeah,
decrease
Oh, sorry, go ahead.
And decreasing government spending.
Yes. Excellent. That's great. And then also someone said sell bonds. That's a good one too. Great work, everyone. And then 4 actions that can be used at a trough to help boost the economy into recovery and expansion are what? Man, me one try. So fiscal stimulus, that's great. Yeah, that's a good one. Fiscal stimulus. What else? Buy bonds and stocks, yes. Excellent. What else? Decrease interest rates, yes. Monetary policy, yeah. So lower interest rates, yes. Professor, can we say things the opposite of things we did during peak? Yes. Yes. So you can you can do the opposite. Yeah. So yeah, exactly, Elmo. So decrease reserve requirements. That's great. That's a good one. Public-private partnerships to boost infrastructure development. That's a good one too. So public-private partnerships to boost infrastructure development. So fiscal stimulus means government spending and lower taxes. So fiscal stimulus means fiscal stimulus is higher government spending
Tissue.
and lower taxes. Yeah, good question. So can anyone think of other ideas for this? We got a lot of good ideas here, but are there any other ones? So usually in fiscal stimulus, governments increase their expenditure to increase money supply. Yep, that's a good one, Hamza. Can we say purchase loans for foreign countries? So we could, for that one, we could say we could borrow from other countries to pay for government spending. So we could do that. And then Hamza said international trade supporting exports, encouraging exports. Yeah, that's good. It's a good one. Encouraging exports, that's a good one. Increasing exports. Yeah. Bailouts, yeah, that's a good one. Bailouts. Yeah. So yeah, great ideas, everyone. Yeah. Excellent work. That's great.
Thank you.
So there's some videos here. I'll post them in, like, if you want to watch them after class. Just gotta figure out which section we were in. Which section are we? So I'll put this in the chat here. These videos here. If you want to watch them after class, it's totally optional. It provides more detail on what we've just talked about. It's totally up to you.